good afternoon. When we look at the current environment, we see central banks basically tightening into a slowing global economy, at least from a Western perspective. And given the level of inflation that they're fighting, we would be first to admit that the range of outcomes for both the economy and the market is very, very wide. Probably the widest it's been in 30 years. So against that backdrop, talking about global equities in 12 minutes, you could cover a lot of different things. I'm just going to focus on three elements. The first is our base case, which is stagflation. And when we think about stagflation, we're in the mild recession camp in the West as opposed to a hard landing. Policy is tightening. But in the East, because China tightened in a preemptive sense and doesn't have any inflation, in fact, they've probably got more risk of deflation, we think China can ease, and global central banks, probably not by design, but may actually get a soft landing. But we still have to deal with inflation, which I'm going to speak to. In this environment, I think there'll be less, let's call it classical rotation. In a stagflation environment, you could say weak businesses, regardless of whether they're secular growers or more mature cyclical businesses, are going to be challenged. So it is, I think, more of an environment to be, it's more going to be driven by stock selection as opposed to traditional factor selection or factor rotation. The second topic, we all know Europe, China have challenges. We would make the case that the market understands those challenges, has discounted or more than discounted them. So against that backdrop, the question is, are they cheap relative to the risks, those markets? And we think they generally are, but stock selection will matter. And then finally, this environment, the third topic is really how do governments negotiate this environment? We think it's less about central bank policy. Whilst it matters, central banks arguably will be fighting against governments who want to stimulate, who want to offset. There's a cost of living crisis that's happening in the West. Social policy will get a lot more focus. You could argue the populism that we've seen in recent times is probably going to continue, especially in the US. Polarization, populism is very real. And the question is, will we ultimately get an investment cycle going that can alleviate some of the downside in the economy? We think there's a couple of ready-made opportunities, decarbonisation, infrastructure spend in the West. We do think we'll get the focus, and we have a number of clusters in our portfolio that will benefit from that type of stimulus in the longer term. Okay, navigating this complex environment, we think really what matters will be paying the right price, sticking with quite resilient businesses and buying them when they become cheap, and paying the right price irrespective of their growth profile, whether it's mature cyclical growth or secular growth. So, starting on our first topic, stagflation, and I'm going to speak to the inflation leg of stagflation. So what we're seeing here is we're mapping out 70 years of data on the S&P 500 using a trailing PE, and we're mapping it against inflation rates. So on the bottom axis, on the x-axis, and on the y-axis, what the multiple has been against those. And you can see unsurprisingly, it's a downward sloping curve. The yellow is the average, the blue is the upper bound, lower bound, and the red dot that you see, or the yellow dot there, sorry, August 22, we have 8.5% inflation, and we have a PE multiple of around 20 times. So fair value at 8.5 is closer to 12 times. Now, we all know inflation's not going to stay at 8.5%. For a number of reasons, it's going to start rolling over. And, the three obvious ones, central banks are tightening. The Fed is about to amp up quantitative tightening. It's running at about $40 billion per month today. Tomorrow, it's going to run at about double that. So we're going to shrink that central bank balance sheet in the US, the Fed, by about $1 trillion, unless, of course, they blink. Now, So we've got money supply contracting in the West. So that's going to bring inflation down. We have goods, like a third of the inflation basket is goods. Goods, let's call it demand, is normalizing post-COVID. And you've also had this sort of zero COVID policy in China, which is starting to normalize. So some of that supply chain inflation pressure is going to go away, and it's going to go away pretty rapidly. Now, the other side of the ledger, though, are, let's call it some of the more structural supply issues. We think there are basically 5. First of all, labour market is very different in the US to what we're experiencing here in Australia. There is fundamental tightness because participation rate dropped post-COVID. We've never seen it like this before, just straight out labour shortages. So wage pressure is real, and there's a structural element to wage pressure. Lack of immigration, ageing population. Secondly, you have the issue of the underbuild in the housing market post the global financial crisis. Now, we caught some of that up with the rebound, the response to lower rates in COVID, but we still think there's fundamental tightness in the single-family home market in the US. Thirdly, you have just the ongoing issues with commodity, energy inflation, underinvestment. We think that's very real. It's 10 years of investing below maintenance levels in the global hydrocarbon supply chain. Post the Ukraine highlighted vulnerability in the food market. And then finally, decarbonisation in itself is a source of structural inflation. Such a monumental investment cycle is required. Now, whilst the dream is cheap green energy, we have to get there. And that's going to drive, I think, some structural elements inflation. So what we're dealing with here is declining cyclical pressure, but building structural pressures. So where we think the inflation settles, the exit level of inflation is what really matters. And we actually think it's probably between 4 and 5. So that means a 20 times multiple. The key takeaway is there's more downside from a derating perspective in the market, which means paying the right multiple matters more than ever. So moving to our second point, China, Europe, the challenges that both of these regions, countries are actually facing. Europe is experiencing, starting on Europe, and what we have at the third issue is geopolitical risk. So I'll start on Europe. Europe, as you know, a third of its gas was coming from Russia, and that supply has been severely rationed. Where storage levels are in Europe today, it only requires a very small proportion of Russian gas to continue to flow to get through the winter without significant rationing. However, that is coming at a pretty severe cost. Importing more expensive LNG, thermal coal, is a 2 to 3% tax on the European economy. So it is, there are challenges. We would argue relative to the price that you're paying, especially for some European equities, multinationals, the companies that we own there, like Sanofi, like SAP, like Siemens, which are actually globally based businesses. You are getting opportunities, I think, to deploy capital. Touching on China, what's important to understand is the slowdown in property is arguably somewhat self-induced. There has been a direct government policy to push weaker developers out of the market and to bring the supply of property more in line with demand. And with activity down 40%, it's mission accomplished. We see policy is starting to really ease on the margin. The developers that the government wants to protect are starting to get backing from the government. And post the power transition, with Xi getting his third term in October, we think policy can shift from a focus on sort of reform, pushing reform, to actually stimulating growth. Once again, if you look at the multiple, arguably a lot is priced in. With geopolitical competition between China and the US, I think what's most important to understand is that in the case of Taiwan, both economies are critically dependent on TSMC for leading-edge semiconductor supply, which they cannot run their economies without. So there is a mutual self-interest from both parties in keeping Taiwan stable. And that is, I think, what controls the risk of let's call it an uncontrolled escalation. Now, we would be the first to acknowledge that clearly miscalculations could occur on either side. But you must read that not as a China risk. That is a global market risk. That is catastrophic for almost all asset classes and markets. And it's not a controlled, Russia-Ukraine situation. It's far more far-reaching. So what we think actually the key risk is, beyond the obvious issues that Europe faces, China faces, it's actually global policy error. That is the key issue that we're facing. And the market that is most vulnerable to that, we would make the case, is the most expensive market, which we're calling out as the US. The look on Jerome Powell's face tells you everything. This is a central banker fighting inflation where elements are structural, where elements are driven by supply, with the very blunt instrument of interest rates and QT. And that's something that central banks haven't done for multiple decades. So turning to the portfolio, very quick whistle-stop tour of where or how we're positioned. In the US, which is our largest exposure in an absolute sense, but also our largest underweight, we are underweight the more expensive domestic cyclical part of the market and expensive software, expensive tech. In Europe, the focus is on multinationals, and in developed Asia, we're in the parts of the market that have been hurt the most by policy, but where we think policy can shift to a loosening bias. We're also very aware of geopolitical risks. We know there are emerging markets that in this world where we're shifting away from a US hegemony to a more multipolar world, there are EM markets that actually benefit from that. Places like Indonesia, India, Brazil can play both sides of the aisle. And we are diversifying some of our China risk towards those markets. Now I'm going to turn to stocks and concentrate on two clusters in the portfolio, the first of which is our energy transition cluster. Energy transition starts with switching off coal generation and replacing it with gas. You cut your emissions by about 50%. EQT is a stock you may not have heard of, but it is North America's largest pure play gas producer. And it's available in the market when you take the current forward curve on natural gas prices in the US on a cash flow multiple to equity of around 25%. It has a very good position on the global cost curve and a very long duration assets. Switching to materials that are going to be used in the energy transition. When we switch to EVs, we need 4 times as much copper. When we have to reinforce the grid, connect all the renewable energy to the load centers, the copper or the grid intensity, the copper intensity of investment goes up 10x. Tech Resources is out of all the majors, has the fastest growing copper portfolio. Its assets are also very low cost. They're based in Chile, and that stock is available to you on a 20% free cash flow to equity at spot prices. Siemens, a stock that we've had in the portfolio for some time. Look, it touches all areas of investment. It is the enabler of building and manufacturing efficiency, transport, where it has a very large rail business, and then its associate company, Siemens Energy, is one of the key suppliers of wind turbines and the electrolysis equipment you need for hydrogen production. So it's a stock on a P of 14 times that we think has got a structural decades of growth ahead of it. And then you have the utilities. RWE is at the center of this European crisis. It's the largest generator of power in Germany, And by the end of this decade, all of that will be renewable based. So it's been very forward thinking in its switch away from hydrocarbons to renewables. Our second cluster is a group of stocks that are all involved in enterprise resource planning software. Oracle and SAP define the segment. Collectively, they have about 50% market share. And this is the software that you need to run your general ledger, your management accounting platform, basically the mission critical software you need to run your enterprise. So you ask, why is that interesting? It's interesting because that transition from on-premise to cloud is still fairly early on. In other segments like customer relationship management, which is dominated by Salesforce, already over 60% of customers have done that switch. In ERP, it's less than half of that. And as you do go on that journey, what happens is there's a shift in value to software. Corporates, they basically go from on-premise, the profit pool shifts from hardware and labor to software. The corporate saves money, the software company makes more money. These stocks are available on 15 times, and we think they can sustainably grow at around 10%. So that's our second cluster. And then I'd just like to wrap it up and bring it together, bring the three threads back together again. While stagflation is our base case, we still think we can avoid a hard landing. It's really actually focusing on what you think the right multiple to pay is if inflation going forward is on average higher. And we think it will be, so we do think that multiple will come down. And in that environment, you want to be quite selective, making sure you're paying the right price. Yes, Europe and China have challenges, but we do think valuations discount those risks. And amongst all the tail risks that we face, we think the key one is policy error. And the way to control that is to, number one, not overpay for your exposure. Number two, look for cheap ways to hedge that risk. Our pragmatic value approach is really looking in this environment, which is very complex, where the range of outcomes is very wide, for resilient businesses that can really take profitable market share in an environment of much more economic volatility. An environment that's more like the 70s and 80s, as opposed to the environment that's been defined post the GFC by QE. I'll wrap it up there, and looking forward to Q&A.
Thank you, buddy.